The Federal Reserve is expected to officially announce a pivot in monetary policy next week. Why choose to cut rates now? Is it because macro fundamentals are strong? Is it because corporate balance sheets are impeccable? The answer is no. The Fed's action stems from fear. They are cutting rates because economic momentum is decaying. They are attempting a defensive intervention against a recession. Observing historical data, the starting point of a rate cutting cycle is usually the beginning of a market correction, not the launch pad for a rally. Look back at 2000. The rate cut landed and the dot-com bubble burst. Look back at 2007. The rate cut began and real estate credit collapsed. For the vast majority of market participants, this moment seems like a highlight in American financial history. Mainstream financial media headlines remain obsessed with the narrative of the S&P 500 and Nasdaq approaching historical highs. Sell-side analysts continue to raise price targets as if this liquidity feast will continue indefinitely. But as a professional reviewing investment portfolios at this critical juncture, I suspect your true emotions do not resonate with the media's carnival. On the contrary, you might feel confused, perhaps even accompanied by a deep-seated anxiety. Since the benchmark indices are climbing, why isn't my net worth expanding in sync? As a disciplined middle-class investor, why am I enduring unprecedented beta pressure in this so-called bull market? Your intuition is not flawed. This is not a failure of your personal alpha generation. It is because the market structure we face at the end of 2025 has undergone a fundamental fracture. This analysis aims to pierce through the fog of macro narratives and take you to the turning point of the cycle to examine the truth of capital flows behind the charts. Over the past 12 months, the US stock market has exhibited extreme dual-track characteristics. If you view the S&P 500 as a single asset, its surface return is highly deceptive. But if you perform an attribution analysis, you will find that internal market breadth has completely collapsed. Quantitative data shows that the vast majority of the index's gains over the past year were contributed solely by those 6 or 7 tech giants, the Magnificent Seven. The weighting of these trillion-dollar club members is so high that mathematically, a 1% rise in their prices can smooth over a 1% decline in the remaining 490 plus constituents. This is like a statistical fallacy. Put Elon Musk in a room full of average wage earners. When calculating the mean, everyone is a billionaire. But does this change the reality that the other 499 people are facing credit tightening? Obviously not. The current US stock market is exactly that room. This is the root of your sense of disconnection. Your portfolio is exposed to the real economy represented by the other 493 companies, while the index is reflecting the AI capital expenditure bubble dominated by the Magnificent Seven. This divergence touched an extreme in 2025. A massive number of small cap stocks, traditional industrials, and even consumer discretionary stocks have actually experienced a stealth bear market over the past year. But this valuation compression was masked by the index's weighting algorithm. For the middle-class investor, unless your position was extremely concentrated in tech giants, you were effectively underperforming the market, or even seeing asset shrinkage. The end of the beta dividend, the negative feedback of passive investing. Reviewing the past 3 years, 2023 to 2025, we must admit this was a rare period of low difficulty investing. The core logic at the time was excess liquidity superimposed on a singular AI technology narrative. In that phase, capital allocation required no deep research. Massive amounts of capital flowed passively into the market through ETFs. You need to understand the mechanical logic of ETFs. When retail investors buy an S&P 500 ETF, the capital is not conducting value discovery. It is building positions mechanically based on market cap weighting. This means the larger the company, the more liquidity it absorbs, the higher the stock price, the heavier the weight, and the stronger the buying power. This is a self-reinforcing momentum loop. This manufactured an illusion. Being long tech stocks is risk-free. But at the end of 2025, this loop is encountering the physical laws of mean reversion. Valuation has gravity. When the price-to-earnings PE ratio overdrafts the cash flow of the next 10 years, any minor earnings miss or disturbance in macro factors will instantly reverse this positive loop into a liquidity stampede. The current market is at this critical point. The passive buying momentum of ETFs is drying up. Retail disposable income is being squeezed by inflation and living costs, leading to insufficient marginal incremental capital. Once passive flows stagnate, the market will revert to the most primal pricing model, focusing on free cash flow and risk premiums. This means that the strategy of blindly going long on giants will not only fail in 2026, but could become the largest risk exposure on your balance sheet. Institutional deleveraging and sector rotation. A more warning signal comes from the institutional side. If you monitor institutional dark pool trading data, you will discover a divergence. While retail investors are still chasing call options in the derivatives market, Wall Street's top fund managers are executing an epic portfolio adjustment. They are not liquidating completely because benchmark mandates require them to stay in the market, but they are rapidly deleveraging and lowering their beta coefficients. Capital is withdrawing from crowded, overvalued tech sectors. This is why recently, even when certain tech companies reported earnings that beat expectations, their stock prices still suffered sell-offs. This is a classic selling into strength pattern. So, where did the money go? Liquidity is flooding into valuation depressions that the market has neglected for 3 years. It is flowing into assets sensitive to interest rates, flowing into traditional industries that possess strong cash flow but lack an AI premium. This is not just a tactical rebalancing, this is a strategic bet on the macro paradigm shift of 2026. If you continue to operate in the 2026 market using 2024 logic, the result is certain. You will become the bag holder for institutional distribution, and in the subsequent asset rotation, you will watch undervalued assets explode while the high-priced chips in your hand shrink significantly. What is needed now is not panic, but a cognitive reconstruction. We need to ignore media noise and focus on the core variables determining asset pricing. This variable will be unveiled by the Federal Reserve next week. The masses view it as a rescue signal, but in my view, it is the starting gun for a new round of the game. Next, I will deconstruct in depth. Why might the upcoming rate cut be the biggest liquidity trap set by the market? When Powell announces we need to lower the federal funds rate, through the embellishment of financial terminology, the substantive signal is economic vitals are deteriorating seriously. If liquidity is not injected immediately, the system may face shock. Scrutinize the hard data of late 2025. This is what the die-hard bulls avoid discussing. Cracks in the labor market. Although the nominal unemployment rate is controllable, full-time positions are bleeding out and new employment is concentrated in low-wage, part-time work. This is a typical leading indicator of recession. Depletion of excess savings. Household excess savings accumulated during the pandemic hit zero in Q3 2025. The maintenance of consumption expenditure relies on revolving credit, and delinquency rates are climbing. Wave of corporate defaults, bankruptcy filings by small and medium-sized enterprises have hit a 10-year high. Therefore, the December 10th rate cut is not a dividend celebrating prosperity, but a crisis response measure. History has the characteristic of mean reversion. In 2026, we will face a refinancing wall. A massive amount of corporate debt issued in the high-rate environment of 2023 to 2024 will mature. Even with a rate cut now, new financing costs will still be far higher than in the zero-interest era. This means that in 2026, corporate interest expenses will not only not decrease, but may actually rise. This lag effect is like a noose, slowly tightening. Especially for those pseudo-tech stocks that lack positive cash flow and rely on financing to survive, the first half of 2026 will present a solvency crisis. The great asset repricing. Winners and losers. Understanding the macro background. What does this specifically mean? A rate cut does not mean a broad-based decline. It means a complete transfer of capital preference. In the high-interest era, 2023 to 2025, cash was king. Capital flooded into money market funds to earn a 5% risk-free return or huddled around cash-rich giants like Apple, Google, because they didn't need to borrow and could even earn interest income on cash reserves. This is the fundamental logic of large caps up, small caps down. However, with the rate cut opening on December 10th, the logic will flip. 1. Risk-free rates trend down. The attraction of cash declines. The $6 trillion locked-in money market funds will be forced to flow out seeking yield. Duration-sensitive asset recovery. Those sectors suppressed by high rates with valuations at historical lows will demonstrate the greatest elasticity. The specific logic deduction is as follows. Russell 2000 small caps. These companies have higher leverage and a large proportion of floating rate debt. Rate cuts directly improve their income statements. For every 25 basis point drop in rates, their net profit could rebound by 10%. This is known as high convexity return. Biotech. Extremely dependent on external financing for R&D, the hiking cycle was their darkest hour. Once the cutting cycle opens, lower capital costs will restart mergers and acquisitions M&A activity. Big Pharma will use cash to acquire undervalued, innovative drug companies. This is where the alpha returns of 2026 will be born. Real estate and utilities. Typical bond proxies. When treasury yields trend down, these assets offering stable dividend yields become extremely attractive, becoming a safe haven for defensive capital. The 2026 dollar logic from siphon to spillover. We cannot ignore the dollar index. Over the past few years, a strong dollar has acted like a vacuum cleaner, sucking out global liquidity. As the Fed cuts rates, if European and Japanese central banks lag in action, the narrowing interest rate differential will be inevitable. Some stocks are value traps, destined to be eliminated, especially the highly touted AI sector, which is undergoing a brutal supply-side clearing. In the past 2 years, a large number of AI application layer companies emerged. Their business models are extremely fragile. Merely calling OpenAI or Google APIs, wrapping them in a web page or app, and earning subscription fees. Technically, this is called a wrapper. Before 2025, they could survive. But in 2026, foundation models are becoming generalized. For example, the once paid PDF analysis function is now integrated into operating systems or free models. This means the value of the middleman drops to zero instantly. The SaaS software as a service field is equally fraught with danger. For the past decade, US market darlings were SaaS companies like CRM and marketing software with business models charging by headcount, seat-based. But the core of AI is efficiency improvement and cost reduction, reducing human labor. This directly impacts the SaaS pricing model. For the past 3 years, NVIDIA was the absolute king. The logic was, the world is building infrastructure, but at the end of 2025, the logic is shifting. As large model training passes the passing grade, the focus will shift to inference, that is, AI application implementation, content generation, and edge computing. What does this mean? Hardware demand shifts from extreme performance to cost effectiveness and ubiquity. In 2026, capital will chase data owners in vertical domains. Only companies with exclusive private data can build competitive AI agents. The endpoint of analysis is execution. In 2026, market volatility, VIX, will significantly shift to a higher center, and the unilateral beta market will end. To capture the excess returns of sector rotation while preserving capital, I suggest adopting a dumbbell strategy. One end extremely defensive to lock in certainty, one end extremely aggressive to bet on high elasticity. Here is the suggested asset allocation model 404020. 1. 40% defensive end. Building a yield moat. This part aims to reduce portfolio volatility and provide cash flow. The early stage of a rate cut is often accompanied by the shadow of economic slowdown. No matter how tech stocks fluctuate, basic living needs are rigid. Allocation direction: focus on utilities, consumer staples, and big pharma. They possess stable free cash flow and high dividend yields. When growth stocks face valuation compression, these bond-like stocks provide a safety cushion. Operating principle: do not seek doubling capital gains. Seek only to beat inflation and control drawdowns. 240% offensive end, sniping the new macro cycle. This part is responsible for generating alpha. Discard the lazy thinking of buying market cap weighted indices, withdraw from crowded tech giants, and precisely allocate to depressions benefiting from rate cuts and hard tech. Allocation direction: Russell 2000 Index. This is the main recipient of liquidity rotation. Rate cuts will repair balance sheets, bringing a Davis double play. Allocation direction B: energy, infrastructure, and edge side chips. These are the real winners of the second half of AI. Operating principle: build positions on the left side in batches, buy during panic pullbacks, strictly forbid chasing highs. 320% hedging end, insurance and dry powder. Never be fully invested in risk assets. This 20% determines your survival rate in extreme market conditions. 10% gold hard assets, hedge against the risk of the dollar credit system. If rate cuts trigger secondary inflation analogous to the 1970 seconds, gold is the ultimate anchor of purchasing power. 10% cash USD short-term treasuries. Wall Street calls this dry powder. 2026 is bound to see a black swan style liquidity shock. When the masses panic sell because they are trapped in full positions, this is your only ammunition to loot premium chips at floor prices. December 2025 is the watershed of the cycle. For the past 3 years, luck has masked strategic laziness. But in the coming 2026, the market will cruelly punish blind followers who lack logic and reward the minority who have insight into macro trends and strictly execute discipline.